advisor Mohammed El Arian. And Mohammed, it is always a pleasure to see you. Your reaction to this economic data that we're just getting this morning, 7.5% retail sales, certainly makes you feel like we are in recovery mode when it comes to retail and jobs.
Yes, Maria, these numbers shows you both what's possible and what we should be worried about. Possible came from retail sales. This economy can take off very quickly if it has the green light. But unfortunately, that's June data. The July data is not going to be as good. Why? Because we know that certain states either halted their reopening or went back. And you're starting to pick that up in the jobless claims. Jobless claims is what we should worry about. The number came in higher than expected. It didn't really improve from last week. And I worry that next week may be even worse. So, on the one hand, there's a lot to hope for if we get the health issue right. On the other hand, it's too early to feel comfortable because the unemployment problem is still there.
So, Larry Kudlow joined me a couple of weeks ago and said that we should expect a 20% growth story for the second half of the year. Do you believe that? Do you think we will see a snapback in the third and fourth quarter?
It all depends on the health picture. I'm worried about two things. One is our inability as yet to open up in a healthy manner, which means that we're like a pendulum swinging around trying to find an equilibrium point to live with COVID, because unfortunately that's what we have to do until we get a vaccine or community immunity. The second thing I'm worried about, keep an eye on the big companies. We're getting announcement after announcement of big companies looking to lay off people. Yesterday it was American Airlines, was 25,000. And I'm worried that we're going to migrate up in the layoffs from the small and medium-sized company to the large one. So I would hope for what Larry is talking about, but I think it's going to be heavy going for a while, unfortunately.
Let me bring in Mark Tepper. Go ahead, Mark.
Hey, Mohammed. So I read your comments about this being a liquidity-driven rally and how dangerous that could be, and the retail investors really being front and center. How much are apps like Robinhood and other apps like that, how much are they impacting what we're seeing in the market right now?
In a huge way, Mark, and in two ways. One is they're reducing the barrier to entry. You can go out now and buy, for example, for $5, you can buy a small proportion of loss of shares. So we are reducing the barriers to retail investors. And secondly, Robinhood in particular is talking to millennials in a way that they like being talked to. Don't get me wrong, it is a good thing that we get broader retail participation. We want this market to be deeper, and we want society to have a buy-in to the market system. But I worry a little bit that they're chasing the market higher and higher. Hopefully I'll be wrong, because the last thing we want is a whole new set of investors getting burnt in their first entry into the market.
Yeah, that have never seen a sell-off, by the way, or have never seen a recession. What do you think's going on with these markets recently? I mean, even with the cautious news on the pandemic, Mohammed, we are near record highs, and yet this morning we get good news on retail sales, and we see the market worsen, down almost 200 points right here.
Yeah, day to day is hard, but I think, Maria, if you step back, there's two very strong factors in play. One is the ability to look through the short term and the hope that a vaccine is coming. And after all, let's not forget that the US economy is incredibly robust structurally and can come back quickly. The second is just liquidity, central bank liquidity. And today we heard from the ECB that they are going to be flat out still. The Fed is giving every indication that it will be supportive of market liquidity, and the retail investors. So I think of this as a liquidity-driven market. It is hoping for a destination that comes rather quickly, and that's what I'm worried about. So the big question is going to be, do we have enough liquidity to continue ignoring tougher economic and corporate fundamentals?
Sure. Liz Peek.
Mohammed, question. I'm struck by the fact that almost every read on the economy, whether it's consumer sentiment or the PMI numbers or today's retail sales, are always better than expected. At least over the last couple of months, that's been the case. I would think that means that earnings also for the second quarter are going to be better than expected. Terrible, probably, yes, but better than expected. Won't that help the market?
It should help the market, and you're getting two phenomena. If you remember March, April, we got hit very hard, and we all underestimated how hard that hit was. May, June, we bounced back much faster than people expected. So the error was on both sides, and I think that has to do with models that are not able to capture this historic shock. In terms of earnings, my gut feeling is that we're going to look through them again. We're going to say, unfortunately, these are dated. These days, a lot happens just from one day to another, as you report so well every day. So I think the marketplace is going to say, that's great. Yes, it's better than expected, but what about the third quarter? What about the fourth quarter?
Yeah, so how do you want to allocate capital amidst all of this uncertainty?
For the last 3 to 4 weeks, I have been cautious and wrong. I've been cautious because despite there being some really attractive companies in terms of themes, and by that I mean strong balance sheets, the world is coming to them. The themes are good. The valuations are high. So I have been overly cautious, and I remain cautious because of valuations. Don't get me wrong. There's a lot to like in various companies here. It's just that valuations have gone really far, really fast.